I'm Omar, Executive Vice President Corporate Business of VeriTran. I'm here with my colleague Greynier Fuentes, our VP Digital Solutions. Before we start our webinar today, I want to introduce our keynotes. George Levy, Chief Learning Officer at Blockchain Institute of Technology, and Ola Henfridsson, Professor of Business Technology at Miami Herbert Business School. It's a pleasure to enjoy our webinar today with you guys. Before we dive into our webinar, we want to provide you a bit of background in our company. VeriTran is a global company that speeds up and simplify application development through our local platform. VeriTran is used by more than 50 banks, reaching 50 million users, and we have 10 billion secure transactions annually around the world. We have success stories on the world with different sides of the banks, and we have a strategic partner with Visa and MasterCard. Today, we are talking about the impact of the digital transformation in the financial industry, and I would like to share with you 3 ideas before to start with my colleagues. Today, we are talking about the tokenization fundamentals with Greynier, George to talk about the impact in the financial industry with exponential technologies, for example, blockchain, and Ola, he's talking about the creating a digital mindset for banking. We have a very powerful webinar for today. I mentioned I would like to share with you 3 ideas. The first one, please don't prepare for change, prepare for acceleration. What do you mean? Today, the exponential technology is to accelerate our change because the old technology, artificial intelligence, blockchain, machine learning, low code is to permit to create time to market to create application or digital application and to unify the digital channels. The second, we need to adapt. Charles Darwin mentioned many years ago. Today is the more beautiful quote with Charles Darwin is we need to adapt to change. We need to have success story, customer experience, and we need to define our customer journey and with focus in the customer centric. And finally, the customer don't compare banks to banks, compare experience. This is the main topic for today to enjoy our webinar. Our first keynote is my colleague Greynier Magic Fuentes. Please, Greynier, go ahead.
Thank you, Omar. Good afternoon, everyone, again. My name is Greynier Fuentes, and I am the VP of Digital Solutions at VeriTran. And today, I will be talking about, or barely scratching the surface of tokenization, what is here to resolve, and some of the benefits. To get started, I'm gonna go ahead and start sharing my screen. All right. There you go. All right, like I said, I'm gonna be talking about tokenization, the road ahead, and I'll be touching on those 3 main topics. To get started, let's talk about some tokenization fundamentals. Basically, replace the card number for a number with a similar characteristics, a token. And just to elaborate a little bit on that, this number will have the same functionality as the real credit card number, to perform transactions. It's going to be similar in the fact that it'll have 16 numbers. It'll be identified by a BIN number, which usually is the first on the traditional banking is the first 6 digits of the card number. Now, tokenization is opening up the space for some cases to be identified not only by the first 6, but it can also be identified by the first 8 numbers, depending on how the bank and that particular BIN number is configured. Now, further to this details, what else tokenization does? Pretty much it replaces valuable information, sensitive data, with a number that cannot be used to trace back that information that is being gathered by the token, and it has no meaning value. So if anybody grabs a hold of that token, it can only get that token and not perform anything else with it. For once, it's not something that you can use anywhere. It's something that goes through a pre-enrollment on a secure device, and it goes through some advanced authentication methods before it's enabled on a particular device or an e-commerce site. And so it goes through a strict verification process before it becomes active in order to transact on behalf of that particular card number and the sensitive data for the customer. So what is tokenization here to resolve? It's here to take care of many things, many aspects. We'll be covering 3 today because I only have a few minutes and I have a couple of great speakers behind me. But what is here to resolve? Especially in the card not present world, like e-commerce sites and some of the secure remote commerce and some of these other things that are being addressed by with tokenization and being the key aspect on the back end. First of all, card not present transactions contribute to 90% of total fraud. This is huge. This is huge, especially these days of with a COVID-19 situation where most of the transactions are happening with on a card not present space. This is the big issue in the world today. Another one is friction. Too much friction at the time of checkout. About 75% of users abandon their cart because of they're not getting that optimized experience, which is another topic that tokenization is here to resolve. Poor user interfaces and inconsistent buying experiences. Users go to different sites and they get different buying experiences. And most of the time they get frustrated, they abandon, and they end up not making that final purchase. Even after investing 15 or 20 minutes shopping around, they go through a bad experience for making that payment, and they end up not executing that payment. So how is tokenization helping this? First, on that first topic there, fraud. Well, it is definitely assigning a token to every different device, every different browser, every different IoT device. And again, it goes through that strict verification process in order to verify that the user adding their financial details and in order to tokenize those future transactions are able to do so in a secure way. So tokenization here in big part is here to resolve fraudulent transactions. So that's a big issue. Now, another thing that tokenization is here to resolve is that friction at the time of checkout. And it's tied to the optimization piece in there. The networks are working very hard, are developing and making available for the e-commerce world and the card on file world, like Netflix, Amazon, etc. Something that's called secure remote commerce. This is pretty much an agnostic payment button, which is, it could be from any network, but it provides a unique and seamless user experience across any e-commerce site using any payment type, MasterCard, Visa, American Express, etc. So tokenization is the technology behind the security and being able for companies to develop a unique and a seamless experience for that end user to be able to have that great buying experience and in turn provide some benefits that we'll cover in just a few minutes. So tokenization is here, and again, I'm just barely scratching the surface of what tokenization is here to resolve. beyond these three that we're covering today because of the time allotted to talk to you guys about tokenization. But it's that technology behind the security, the user experience, and making sure that
Sorry, we have a problem with the connection with Greynier. Give me 1 second.
I hear everyone. I'm sorry.
Okay.
In my screen, I hear everyone.
Okay.
Omar, are you hearing me? I hear everyone. I hear you. I'm sorry.
Yes, Greynier, go ahead.
Oh, I'm sorry. I was on the same slides. I haven't moved from it. I was saying that, you know, tokenization is the technology powering, you know, and addressing this this issue with fraud, friction, and optimizing the user experience across all channels, and, you know, without compromising the secure and sensitive information from the users, and allowing banks and issuers to take better decisions at the time of transaction goes through. So with that, I'll jump to some of the ultimate benefits of tokenizations. Security, again, all of the sensitive data, it's not exchanged between the consumer, the merchant, and Visa. Only tokenized data is exchanged, and then Visa and the bank tokenizes those transactions, and it communicates with the issuer or the banks in the traditional secure manner. But it's removing all of this sensitive data from the merchant and the end user, so the user can go and transact freely without having to worry about their data or their sensitive personal information being stolen at the time of a purchase. So with that in mind, this brings us to another benefit, which is approvals. Tokenization is set to increase the approval rate between 30 and 35%. That means today it's at about 60%. That means taking authorizations and approved transactions up to 95%, which is huge. We're talking about billions of dollars in transactions that today are being declined because there are no secure channels, or that they're coming from suspicious activity, and they end up being blocked. Now, applying tokenization to this will eliminate that, because the issuer, with the use of tokenization, it is involved in real time with a lot more data to work with and make better decisions. And one being the fact that it is coming from a secure device that went through a previous enrollment and went through some different methods of security to prove that the information that was being tokenized was from that specific owner. So benefits for both people making purchases and the networks and the banks being able to approve more transactions without the risk of fraud. And one of the benefits that I've narrowed down to three, again, because of I'm just scratching the surface, standardization. Being able to provide end users with that unique experience, regardless of whether they go to Amazon or any other e-commerce site, and being able to give them a seamless paying experience or buying experience, will reduce that approximate 75% of cart abandonment down to about 10-15%. So we're talking huge numbers here by applying tokenization to the back end of card not present and even card present because of the security measures and the obvious benefits of for the banks and the issuers, as well as the ultimate user experience and seamless across any e-commerce or card present site. With that, again, my name is Greynier Fuentes, VP of Digital Solutions at VeriTran. Here's my email, and I will be happy to answer some questions at the end of the webinar using our Q&A session here on the webinar. And I will now pass it on to George Levy, who will be talking to you guys about blockchain technology. George?
Thank you very much, Greynier. Excellent session. I love the fact that you started with the concept of tokenization. That's a big component also that ties in with blockchain technology. The section that I'm going to be speaking about right now is I'm going to focus on the impact of blockchain technology on financial services. Just to confirm, I want to make sure that everybody can actually see my screen. Yep. Cool, great. So to start this whole thing, I want to actually get to know a little bit better the audience, and I want to ask a very simple question. How many people in the audience currently own any cryptocurrency? And I want to do this so I can get a better feel of who's actually out there. The reason I'm doing that specifically is because for a very long time, when I actually started teaching this course back in around 2016, things got to the point where you know, I would begin by saying, who had ever heard of what Bitcoin was? And at the time when I began, nobody even knew what Bitcoin was. So over time, I started saying, well, how many people know what cryptocurrencies in general are? Now it's to the point where I ask how many people own cryptocurrencies, and I want to know specifically how many types of cryptocurrencies. So right now, you should be seeing on your screen, you should have an opportunity to be able to answer some questions. I want to confirm that that's actually taking place. There should be a survey being passed out. So to the team and Omar, I want to confirm that if we can get from the Q&A section, if anybody wants to leave any specific comments in the chat, just to let me know that in fact there has been the Q&A has actually been put out. If you actually have the option to answer the poll. Okay.
Yes, it's been put out, so we should be getting the answers shortly from the attendees.
Okay, perfect. I want to make sure that we get that because I'd like to see I see here somebody said poll is not showing up on the screens. Well, if you can please share that with me, because as we go, let me just dive in because my time is limited and I want to make sure I give everybody the most value for this. What we're going to be covering today. So specifically, I am going to be starting with cryptocurrency and financial disruptive innovation. And I want to put in context the concept of disruptive innovation, because that's going to be a big, big deal as we get through this conversation. What Greynier spoke about and the impact of tokenization has the potential to disrupt the way that people do things. Blockchain has that potential in cryptocurrency as well. This is a lot of the focus we're going to be talking about today. From there, I'm going to go into some real blockchain use cases in the financial industry. The reason why I want to do that is because for a very long time, there was a lot of buzz around the fact saying, you know, blockchain is all smoke and mirrors. Yeah, you know, you got this Bitcoin thing, but nobody's really using blockchain. No, that has changed. There's some real practical use cases of blockchain going on right now. And I'm going to put out some for you so you really see the impact of this. Then I'm going to get into a section called stable coins like Libra and JPM coin. And I'll tell you exactly what stable coins are because it's a type of cryptocurrency that truly has the potential of disrupting the financial industry in general. So let me just get started on the section of cryptocurrency and financial disruptive innovation. First thing I want to do to make sure that we're all on the same page is let's go over the big idea. Whenever you send money to anybody else over the internet, you need to use the services of a third-party agent. That could be a bank, it could be a credit card, it could be a clearinghouse, say for example, PayPal. You can't simply just take money, put it onto an email like an attachment and send it to someone else. You need a third party. That third party controls the transfer. They're basically in the middle. That actually is a very powerful position to be in because they could prevent you from doing the transfer, or they could reverse the transfer, or they could simply just not do business with you. Having that middle third party is a very centralized power position that right now is held by banks, credit cards, and clearinghouses. that entire transfer is controlled by that third party. In fact, like I mentioned, the third party could reverse the transfer, or they could basically just decline it in the first place. Now, when you're dealing with Bitcoin, the transfer is actually done peer-to-peer. You simply send a Bitcoin directly to someone else without needing to go through a third party. All of this happens over the internet in something known as the Bitcoin network. This is a network of thousands of computers all around the world. And those computers are using this technology called blockchain. Now, because of the fact that this is actually happening peer-to-peer, that transaction is considered disintermediated. Why? Because there's no intermediary middle party to prevent or control or manipulate what could happen with that transaction. Additionally, it's also considered decentralized. Why? Because there's no centralized entity that controls the transaction. There's no control over it. And the final approach that I want to focus on is that it's sometimes referred to as being trustless. And that's because there's no need to trust that a third party will actually do this transfer. The network itself has the trust built in. Because of this, it's considered trustless, okay? So as we go through this transaction, that transaction goes directly from one party to another directly. Okay, so let me get now into the concept of disruptive innovation, because of that specific big idea I just showed you, it has the potential of basically rendering banks and credit cards and other third-party payment mechanisms, render them worthless or unnecessary. Bitcoin doesn't need a bank to approve for you to do a transfer. There's a lot of things. So let me briefly explain to you what disruptive innovation is. And this is actually according to Clayton M. Christensen, who recently passed away. I knew him. I got to work with him. Brilliant man. And his definition is disruptive innovation describes a process by which a product or a service initially takes root in a simple application that begins at the bottom of a market, typically less expensive and more accessible, and then moves up market, eventually displacing established competitors. I think the best way for me to describe this is by giving you some clear examples. Nowadays, everybody uses Netflix. You sit at home, you stream movies, you basically watch your movies, you get them there. Well, guess what? There used to be a business called video stores. Blockbuster was a multi-billion-dollar company, and there were video stores all over the nation. I remember I actually had a job. One of my first jobs ever was working at a video store. That was completely disrupted and eliminated. Let me give you another example. Nowadays, whenever you want to take pictures, you pull out your iPhone or your Android device and you take pictures. These digital cameras that are now part of our phones completely eliminated the need of having film cameras. I remember in the early days, I always had to worry about if I was going to run out of film, right? And you had different cameras that required all this film. Then you had to go and, develop the film over at, say, Walgreens or any type. There was a whole industry around developing films. That's completely wiped out. It was disrupted by the advent of digital cameras. Nowadays, we're all used to Wikipedia. Whenever you want to find out the definition of anything, you want to find out anything, you just look up Wikipedia. Well, there was a really massive industry around encyclopedias. That's a business that's gone. In all these cases, disruptive innovation started as a lower price, less quality object, which really started improving until it got to the point where eventually it just eliminated the main established player. And that's what I want to talk about because it opens up the question. Could blockchain and cryptocurrency reduce or eliminate the need for banks? And let me give you a clear example, and actually let's go through some numbers. If we look at the concept of annual remittances, en español se dice las remesas, ¿no? When you send money from one country to another, the money that goes out of the US is $68 billion a year. Of that, around 32.3 billion go to Mexico. Mexico's primary use of remittances is actually inflow. It's money coming into Mexico. So we're talking 68 billion coming out of the US, 32.3 billion coming into Mexico. The global remittance market is around $689 billion. That's as of the year 2018. So in order to actually take that, and let's just go through some real numbers. So, and I'm going to do that by comparing a money transfer transaction versus a transaction taking place on Bitcoin. So when we look at money transfer services, the average fees are between 0.5% to 3.9% per transfer. That's a percentage of the transaction. So we have to look at the transaction size, and then you put a percentage of that transaction. Additionally, the person who receives the money may also have to pay a fee. I know that personally because I actually used to take a lot of wire transfers previously. Nowadays, I don't. I just accept payments in crypto. But whenever I used to take a wire transfer, I always had to pay a fee in addition to what the other person had to pay. This is also subject to a margin on currency exchange rate. Right now, banks average about 5% on that money transfer. So if you actually are taking money in from pesos argentinos or from Mexican pesos or from, say, from yen, you're coming money in from Japan, you have to pay a transfer fee in exchanging it to whatever currency you're taking it. So that's another fee on top of that. Typically, these transfers take between 24 hours to 5 days, depending on the destination of the transfer. For most of my money transfers, typically it's around 48 hours. So whenever I was getting a wire transfer to someone else, I have to wait 48 hours to be able to get it. Okay, it's also subject to extensive regulations and forms to fill. If you get more than $10,000, you definitely have to fill out a form. Why are you taking so much payment? You got to deal with anti-money laundering, know your customers, a lot of regulations. Now, let's just use an example. And I'm just going to use this example just to put a concept. $257 million. If we apply these average fees, on the low end, we're looking at 1.2 million. On the high end, it's 10 million. Now, mind you, you may be able to negotiate a lower price, but the key point I want to say is it's still a very large amount. And I want to use as an example just one transaction on Bitcoin. This is an actual transaction, which if you want to take that same transaction ID that you see right there, that's actually a hash to a corresponding Bitcoin transaction. This was a transfer of 66,233 Bitcoins, which was $257 million at the time of transfer. So think about it. These were $257 million worth of Bitcoin that were transferred in that single transaction. It was sent and it could be received anywhere in the world. It was received and received full confirmation in a matter of minutes. So you would receive notice that the transfer had been sent to you practically instantly. And then you have to wait to what's known as a confirmation, which is when it's added to a block on the Bitcoin blockchain. And eventually it's permanently and immutably inside the blockchain. Okay? No forms were necessary to do this transfer. The total cost of this transaction was $43. Okay, so can you see how this can make banks a little uneasy, where you can send $257 million worth of Bitcoin for $43 versus what you could do with $257 million? This is where I'm talking about disruptive innovation. Here's another transaction just to put to you. This one's actually $194 million worth of Bitcoin for only 10 cents. This truly is one of the reasons why many banks have actually been looking at cryptocurrencies and exploring it both as a threat and as an opportunity. And that's what I want to point out, because it's not necessarily an opportunity. Sorry, not necessarily a threat. Blockchain technology can be used by the financial industry, and it is. So what I'm going to do right now is I'm going to go through some real blockchain use cases in the financial industry to show you some of the things that are being done. Banco Santander has an offering called Santander OnePay FX, which offers same-day international money transfers. Now, you remember all the different things that I told you about the money transfer challenges. Some of them take between 24 hours to 5 days to be able to succeed. Well, this is actually a same-day international money transfer. This was launched in 2018. It uses a technology called Ripple. You may be familiar, there's a cryptocurrency called Ripple. Well, the company that creates Ripple has a technology called Ripple X Current, and it's a blockchain technology that Santander is using for this product. Whereas traditional cross-border payments can take up to a week, with OnePay FX, you can process the payment in the same day, or if it takes a while, it's occasionally the next day. Still, a lot faster than a week. When you compare money transfer fees, sometimes they exceed 10% of the payment's value when you're dealing with these international money transfers. There's no transaction fees when you use OnePay FX. So what I want to point out to you is that this is an opportunity for a bank to disrupt itself, which is one key thing that if you look back at what happened in the music industry, when Napster came out and people were able to exchange MP3s, the music industry tried everything they could to stop MP3s. And it wasn't until they were able to modify the model, and nowadays you're able to stream music, you're able to buy digital downloads, that the music industry was able to embrace this new digital medium. Well, in this case, banks are doing now what they should have been doing, which is instead of looking at Bitcoin and cryptocurrencies as a threat, they're looking at blockchain as a way to be able to embolden themselves and disrupt themselves so that they can be the ones who create the new business models. Beyond Santander, I want to talk about Circle Pay, which lets you send money across borders and currencies for free. You can do instant transfers with simply a text message, and you can cash out your money to a debit card instantly. As it currently stands, it's available in 29 countries, and you can send US dollars to British pounds and euros. It uses a technology called a stablecoin. I'm going to tell you briefly what stablecoins are in my next section. It lets you send to anyone, anywhere across devices and platforms. That's the vision for Circle Pay. Money should be free to be able to transfer and move to anyone or anywhere across any device and platform. And you can do so by using iMessage or a text or an email. So very briefly, sending money is just one of the areas where it's being done. Right now, blockchain is being used in retail lease guarantees. There's a big problem when you're dealing with retail leases. You know, if you have all these shopping centers and you have all these stores, a lot of these leases are being kept on paper. Well, that's a lot of problems for people making mistakes or tampering with the information or basically losing a paper. There's a lot of inefficiencies. Well, by reducing the need for these paper-based leases, they have been able to standardize these lease guarantees. This platform is actually built using a technology called Hyperledger Fabric, which is being pushed primarily by IBM. It's a permissioned private blockchain. HSBC has actually been applying blockchain to soybean trading, and it's actually moving these commodities around the world. HSBC Singapore is using it. They were able to speed the process of exchanging a letter of credit, which is one of the primary areas where you actually do these transfers, from 5 to 10 days to only 24 hours. All of this was built on a platform called R3 Corda, which is another type of blockchain. And I am going to finish now with a section on something called stablecoins, because this is a word that I want you to keep in your mind because you're going to be seeing more and more of this. A stablecoin is a digital asset that is pegged to or backed by another asset. As such, it retains a stable value and avoids market price volatility. The reason why I'm saying this is that many people look at Bitcoin and they're afraid of using Bitcoin because the price of Bitcoin might go up, but it can also go down. Well, if you're using a stablecoin, that's not a problem because a stablecoin is actually backed by another asset. For example, USD coin is a US dollar backed stablecoin. This is done as a partnership between the company Circle and Coinbase, which is a very well-known cryptocurrency exchange firm. And what they're able to do is that this USD coin is regulated, transparent, and verifiable. Each USD coin is $1, and they can actually simply switch from dollars to these USD coins. So you don't have to switch a big conversion. It's 1-to-1. This whole thing's built on the idea that money should be like the internet, accessible, empowering, and instant. This is exactly the stable coin that lets the vision of Circle happen. Remember, I just spoke to you about Circle? They're using this stable coin called USD coin. It is fully secure and all USD balances are FDIC insured. Are you seeing how cryptocurrencies are now behaving more like fiat currencies? Libra is a new cryptocurrency that's being developed by Facebook. It's still not available, but it is a stable coin as well. And the vision for this is a simple global currency and financial infrastructure that empowers billions of people. This is governed by a nonprofit called the Libra Association, not by Facebook. And they're doing this so it doesn't seem like a fully centralized entity. Calibra, which is actually the company that runs the wallet for this, is already a financial institution, and it's registered as a money services business in all 50 states. However, it's dealing with some regulation issues, including unfair competition. The reason is because the moment Libra goes live, if it does, it's going to immediately be able to use WhatsApp, and there's just a massive footprint that would just basically shut out stablecoins and maybe render a lot of banks unnecessary. Because if you can do everything via WhatsApp, why would you need a bank to do the money transfers? And my final point I want to point out is that even the main banks, JP Morgan, rolled out its own stablecoin called JPM Coin. JPM Coin has a value equivalent to $1, and you can transfer them instantly and redeem them for an equivalent US dollar. This reduces settlement time because you're able to do an instant transfer. As it currently stands, it's available only to institutional clients, but it has plans to expand. This is built on a platform called Quorum. So this completes my presentation as far as the topics I wanted to focus on for this presentation. I want to leave you with the opportunity that you have. If you're interested in learning more about blockchain, there's a very special offer for you to get a full blockchain certification, which gives you 6 courses. The regular price for that certification is normally $1,794. But because you are part of this webinar, it's actually reduced to only $594. And you can do that if you're interested in getting this certification. You can visit blockchaincenter.com. And that completes my presentation. Now I have the great pleasure to be able to hand it over to Ola. And thank you again. I hope this has been valuable for you. Ola, if you could take over.
Absolutely. Thank you so much. I'm just sharing my screen here. Hello, everyone. My name is Ola Henfridsson. I'm a business technology professor at Miami Herbert Business School. So essentially what I'm going to talk about here, relates pretty well with both the previous presentations. And I will talk briefly, in general about digital transformation, but in particular about the need to develop a digital mindset. I mean, we're all aware of the many promising technologies in banking. We have artificial intelligence, big data, cybersecurity, blockchain, tokenization, and so on and so forth. And the business landscape is changing. It's not only changing, it's even accelerating, as pointed out earlier here. And it's, of course, very important then for banks to change as well. But part of this is not only to adopt new technology, it's also about developing a mindset that makes you be able to actually realize that potential. I mean, it's in a sense, it's a mindset where it's not business as usual, but it's also a way of trying to accommodate the new technology and use the opportunities associated with it. So I'd like to start by looking at some of before going into what a digital mindset would consist of in banking, I'd like to speak a little to the different forces of change that is pretty exciting here. First of all, I think one important notion here is consumerization. Think about the fact that traditionally when you develop IT in banks, this is done by the IT department, big IT functions. In our studies, we studied Deutsche Bank's IT department, for instance, and their IT function, and how they try to transform this into a new way of delivering IT. Because the main thing here is, of course, when banking becomes an experience, when the end user is the individual consumer, the way we develop IT in banking also has to change. This is difficult, of course, because there are established ways of developing IT, and we have different, it's compliance, security aspects, and so on and so forth. Other force of change is platformization. This is covered from The Economist a few years back, and it really shows, the new power of data and the existence of tech companies. And the tech companies are also coming into this space. Consider that since the financial crisis in 2009, banks have been very occupied, with handling the aftermath of this crisis, which, so they've become very great at securing people's money, being able to be secure and compliant, making sure that balance sheets become clean, and so on and so forth. But because of this focus after the financial crisis, they haven't paid so much attention to innovation, I guess. Meanwhile, we have a number of new, very powerful companies. And they're not only powerful in terms of the market capitalization, they're powerful because they are part of the consumer's everyday life. So if you use your smartphone for most of your consumption, of course, banking will also become embedded in that kind of experience. And part of that is, of course, to try to relate to this. Think about the fact we were talking about payments, George spoke about payments. Think about WeChat, Apple, Amazon, Google, all of them going into this space. And that's what, platformization is about. Another aspect which is very important, I mean, in terms of technology becomes more affordable and accessible. I mean, we also have digital natives coming up, you know, having these touch points with technology. And this means also that some of the traditionally unserved markets are becoming more and more important. Think about China. Think about the fact that China had a middle class for a very long time that didn't even have credit cards. But of course, with new services, they're kind of taking the next step already in a sense, and where payments is very natural, when mobile payments is very natural part of their everyday life, where credit checks is done in a quite unusual way with databases from social media and so on and so forth. Speaking about data, datafication is a very important part of the force of change here. First of all, it can be very important in terms of decision making. It can personalize customer services. It can help out with fraud detection and prevention. And certainly it can help out with front and middle office automation. All of these changes are ongoing. And on top of that, we also have the virus, where the kind of rapid acceleration of user adoption when it comes to peer-to-peer payments, online banking, and so on and so forth. This is very natural for any digital native. But of course, people who have been resistant has perhaps adopted this at a very big scale. You can see some data here. It's research-based. It's McKinsey from March, just showing the increase for different categories here. And of course, if this crisis lasts for long, it of course means that some of the existing user patterns might solidify, making it even more important to take the next step. All right. So how can we turn around this, not seeing this as a threat for banking, but rather taking on a mindset that helps addressing it? Well, basically, I'm just going to outline, briefly, four elements of a digital mindset, which can helping out there. So Jeff Bezos, well, he's famous for leaving an empty chair at the conference table, letting people know that it's reserved for the most important person in the room. That person is the customer. And so as part of thinking, addressing customization that we discussed in the very beginning, we need to think about customer needs first, and then, what kind of processes we have in order to execute or develop that value. Traditionally, we have a tendency to focus on what we can deliver and see who our customers would be, but rather and that would be inside out, inside out thinking. While outside in thinking takes the customer journey, takes the different touch points that the customer might have and the different pains that it might have in different parts of their journey as a basis for doing this. It was funny that George mentioned Professor Christensen, the late Christensen here. He also says that customers don't just buy products, they hire them for a job, just emphasizing the idea that needs comes first. So while most organizations are set up as solutions to a problem, it becomes even more and more important to think about, what are those needs and how can we use our existing IT infrastructure and new technologies coming up in order to address this in a smart way, making sure that we do banking primarily rather than preserving what we have. I wanted also to use a case here. It's from DBS Bank in Singapore, and who you might know. It's one of those companies that have been very successful in terms of transforming themselves digitally, and still trying to develop a startup mindset in a big bank. And their transformation journey started already in 2013. he started really in a customer satisfaction program called RED, which was a few years earlier, because they discovered that among banks in South Asia, they weren't not even, weren't number one, they weren't number two, they weren't even number three in terms of customer satisfaction, and felt that, well, we need to, develop this further and be able to serve our customers in a good way. They started with a process improvement program. And of course, process improvement, that's more like it's more like an inside out thinking. You take existing processes and you think, where are the slacks? Where are the possibilities to improve and make this more efficient, and so on and so forth. But about the time when they started their digital transformation journey, some of their executives come across human-centered development and design thinking and felt that, what can we do with this? Adopting more of an outside-in thinking where we focus on our customers and the emergence of a new set of digital natives and others who are, our emerging customers, and be able to think about how you actually present and give the best customer experience, and how can you actually organize yourself in a way to serve that. They actually adopted design thinking and set up a number of hackathons early on, where hackathons would be, gatherings where you pull yourself together, in a closed room. You get Coke and some food, pizza perhaps, and in order to develop new services. That's the tradition. I guess DBS Bank took this into the banking context, and you can actually see some pictures there on the right-hand side. This is coming from research from some of my colleagues that I'm working with. And so basically, even executives was part of this. So in a way, this was a way to try to develop pockets of innovation within the bank, and also later then try to scale that up into a big improvement program going to outside-in thinking. So how do you actually institutionalize this? Because in a way, you cannot do hackathons after hackathon after hackathon. You need to be able to take on those ideas, implement them in a bank. Well, they came up with this new bank. It's a hybrid in a sense. So it's called the Digibank. And during this time, they actually also wanted to expand into emerging markets. Think about Hong Kong and Singapore at this time. They were suffering a little from the financial crisis. And so as part of DBS wanting to expand their business, they went to emerging markets where many people actually had leapfrogged, from no technology to smartphone technology, skipping laptops and personal computers, wired internet connections. And so 12 countries, they rolled out in 12 countries in 12 months. And part of this was a best-in-class platform, something that makes it easy to develop new services, as well as partnering, perhaps with fintech startups, for instance, that might be able, that already perhaps exists here. Because in a way, it was very important also to be able to, connect to other services and people with local knowledge and skills. So partnering. So actually, DBS used this. Bill Gates already in '94, he was very wise and mentioned that banking is necessary, but banks are not, already in '94. But DBS used this, this sentence as a source of motivation to be able to make sure that they actually were able to do banking. And they also wanted to make a statement that, well, we're still around, it's 2017, we're still around, but it's because they do banking. I'm going to wrap up very soon, but I'm going to give you 3 more points a little less elaborately. So agility is a very important part as well. Traditionally, IT projects in the banking system, in the banking world, is mega projects. They cost a lot, they take a lot of time, and so on and so forth. And that's not surprising. Think about the fact that many banks were computerized already in the 70s, in the 60s and 70s. So lots of legacy systems. There's a lot of things that can go wrong and so on and so forth. Still, it's important to think about the possibility to have a more agile approach where experimentation, iteration, instant release is part of it. And just think about the A/B testing that a firm like Netflix does in order to be able to provide better customer service. I mean, they have 1,000 concurrent active experiments ongoing all the time, and 150 new major experiments per quarter. And each customer basically are part of 50 active tests. So in a sense, this is also a way to calibrate their technology to improve it on the spot, you know, and seeing each release not like a mountain to climb, but something that is part of routine. And this can also, you know, of course, be accomplished with better technology. I give you another glimpse here when it comes to the use of Scrum and Agile, ways of working. We have Spotify as a famous example, and their engineering culture. And of course, this is also something that DBS was very inspired from, you know, being able to find new ways to work like a startup, you know, within the bank. So that's agility. When it comes to flat platforms, I mean, it's part of this, very, very clearly part of this. You know, a traditional definition of a platform would be a set of subsystems that form a common basis from which to develop derivative products. And of course, it's the idea to be able to reuse the stable core, to be able to, I mean, things that don't have to change, just keep, and be able to change those parts that is towards the customer in a sense. It's a way to make sure that you can do iterative and fast development. It makes it possible to recombine ideas, to have an innovation focus in the sense that if you want to partner with a fintech, for instance, you can do that by providing an open API or having a software development kit or something that makes it possible. So lastly, obviously data is very important. And this is from Gartner. It's just a way of looking at data as in terms of descriptive analytics, when you try to find out, you know, what happened. Diagnostic, that, you know, dwells into the causes of the happening. Predictive, that would be, you know, how can I actually predict the next move from the customer? All of these technologies are very, and this kind of data-driven approach is of course very important in banking, and can build the basis. Even though, of course, if you look at one of the latest Harvard Business Review papers, which I forgot the author right on the spot now, but it's on process automation, is the use of AI for be able to take care of some of the middle management behavior in banks. All right, so essentially what I'm been saying here is that there are a number of forces of change. And as George mentioned, we need to think of this as something, you know, that is ongoing and very important, including like customization, platformization, democratization, as well as datafication. All of these forces create a new environment. It doesn't necessarily kill banks, I think, at all, but it provides a new threats, perhaps, but also new opportunities. Part of adopting new technologies, though, will be also to adopt a new digital mindset, where digital questions, you know, move into the boardrooms and become, you know, part of the digital is so intertwined with the core processes. So we cannot treat IT as just this function, you know, supporting existing business processes, but it's very much, you know, at the heart of developing customer experiences. As part of developing that digital mindset, there are 4 elements. You know, having an outside-in thinking, where focus on customer needs and be able to build solutions that match customer needs rather than having solutions and see who's out there in a sense. agility in terms of being able to experiment, iterate, and do instant releases. Think about it. This is the way that tech companies work to a great extent. They have brilliant platforms and they do instant releases. Flexible platforms, very important as part of this, and data, of course. I think I'll consume my time here, and I will leave the floor back to Omar, I think. So many thanks for your attention. These are my contact details at Miami Herbert Business School. And well, thank you for the attention.
Thank you, Ola. Thank you. Great stuff. Great content. Thank you, George, Greynier. We have 5 minutes for making questions. We receive a lot questions for you. We need to finish in 5 minutes, but if you have more questions, please send us email webinar@veritran.com. My first question, we have 3 questions very quickly. My first question is for you, Ola, is please very quick. If you like to choose one component in the mindset, what is what is the main key component for customer journey in our digital transformation today? What is the key component? You need to choose one. And why?
One of the 4 elements. Well, I think it's really the outside-in thinking, because the other ones really build on that. If you think about the data, for instance, it's really about tapping into customer behavior in a smart way in order to develop services. Of course, that requires a platform, so they kind of they are interlinked. But I would say outside-in thinking, because that's probably the most difficult to adopt in a sense in an incumbent firm.
Okay, thank you. Yeah, I do. George, thank you. It's very useful your information for us. If you like to mention what is the more application with blockchain for the banks, what do you think in this time, COVID-19, what is the major use case for blockchain for the banks?
If you're talking specifically within banks, because blockchain is being used for a lot of different things. I would say during this COVID epidemic, one of the areas, and let's just step for a second, you talk blockchain, supply chain management. Blockchain is being pushed across all of our supply chains. There's a huge challenge right now going on with our supply chains. Let's step specifically in the financial space. So right now, a big challenge with people is being able to move money around efficiently and not having to worry about, blocks and transfers. So key things that are happening is a lot of the banks are looking at these stable coins, for instance, the JPM coins, the USD coins, all these ways, because you can do an instant transfer and not have to worry through the old legacy technology of doing a transfer from one bank to another one. It's just old technology. By leveraging these blockchain platforms, money moves a lot quicker and more efficiently.
Thank you, George. My last question, we have 1 minute, is my colleague, Greynier. Greynier, you talk about the tokenization. For you, you are the expert in tokenization. What is the major benefit for the banks when to implement tokenization?
Well, definitely security, better customer experience, and being able to make better and more informed decisions at the time the transaction is going through. But definitely making sure the transaction it's coming from a secure, previously enrolled device, and therefore increasing the approval rate.
Thank you, Greynier. Thank you, guys. Thank you, Ola. Thank you, George. It's excellent content, excellent webinar. And see you in the second phase, maybe in June or July. Thank you, everybody, to connect with VeriTran in our webinar series. Thank you so much. Stay safe.
Thank you, everyone.